Number three, global markets are now extremely nervous. So, if you look at markets, markets appear to expect a major disruption in the US, um, and potentially other Western economies. Now, very importantly, previously solidly safe US government debt is considered riskier than Chinese equivalents, while the price of gold is reaching all-time highs. Now, this is what for me was quite nerve-wracking, because neither Glenn nor I consider the Chinese economy as particularly resilient. We've talked about the soft underbelly, the real estate market. We've talked about the decline in demand. We've talked about the brittleness of China's authoritarian regime. We've talked about how Xi Jinping's zero COVID policy was misguided. We've talked about how, in the era of protectionism, China cannot ramp up exports or even maintain its exports. So China will need a new model. And with China aging, there are a lot of problems in store. Now, having said all of that, and again, I'm going to show you a figure this time that FOI, our geopolitical risk advisory arm or company, has made, and the managing partner Sanjay Acharya and the other partner Manu Sharma have come up with. Manu is an economist, and Sanjay, of course, studied economics and knows technology and loves numbers. And what is interesting is this wonderful chart, which you can see. Look at the yields on Chinese debt in the market. Sometime after the Russia-Ukraine war breaks out, the yield on US government debt is higher. And we are talking about 10-year government bonds from the US and China. And this is very worrying, because the market seems to think that Chinese debt should be okay, should be all right, for all the problems that Glenn and I have talked about for months on end. But US debt is not quite kosher. And why has this happened? Well, multiple factors have contributed to the switch. US has been spending too much for a while. There have been oil price and supply chain shocks after the Russia-Ukraine war. Most importantly, we take the view that fundamentally the markets are spooked by political paralysis in the US. When there is political football over the debt ceiling, when Congress cannot agree as to what taxes to cut, what expenditures to cut, what taxes to raise, and where to spend the money. It is the stability of the US itself that is leading to such volatility. And if you see the other indicator of volatility, which is the price of gold, because gold is a safe haven, gold does not have any intrinsic value. It's not that you can take gold and eat it. It's not that you can take gold and sow gold and survive later on the harvest. Gold is fundamentally a medium of exchange, a store of value. And so is currency, really, but gold is perceived, because of its limited supply and because demand is high, gold is seen as a better store of value than, say, dollars or euros or any currency, really. And what we see over the years is that gold price, particularly after sometime before 2023, starts going up, and it's gone way up, and away. And this shows that markets asset prices to drop. Because historically, whenever gold, silver, platinum go up, that is precisely the time when they start going up. That's precisely the time you expect some sort of financial crash, some sort of asset price meltdown. And are we living in an asset price bubble? I have long maintained we are, because we've had quantitative easing for a while. because too much money has chased too many assets. But that's neither here nor there as of now. The most important metric for us to consider is the two metrics which are important to consider are yield on US government debt has gone up and gold prices are steadily going up. These suggest that financial markets attach an increased likelihood of instability in the Western financial system. Now, given the system's complexity, changes in the real economy, any change could have unforeseen consequences. Go to 2023, Silicon Valley Bank failed. Fed increased interest rates. This led to a fall in the value of long-term government bonds, because when interest rates go up, prices of bonds fall. And what happened was that suddenly the US banks required capital base. Silicon Valley Bank fell short of it. That means that the bank was technically in trouble, and the depositors lost faith in the bank and rushed to withdraw their money. There was a bank run, and $42 billion were withdrawn in a single day. So did anyone anticipate it? Not really. But one small tremor triggered that. And of course, the institutions stepped in, and the institutions were able to bring stability. But right now, the institutions themselves are being attacked, themselves are weakened. And as a friend in Wall Street said, and I was discussing this with Glenn just before we started, is that he was saying, look, the current administration is knocking off bricks. Fine. Some of them probably needed to be knocked off. But if you knock too many bricks, then the wall could come down. And therefore, we think that we may not know the exact drivers. We can theorize. Of course, credit debt is very high. Credit card debt is over $1 trillion, and interest rates on credit card debt is super high. Alex Loy will tell us as a percentage of total household debt, it doesn't really matter. He knows more about numbers, much more about numbers than we do. But the bottom line is that financial markets doubt US financial stability. Europe is in trouble. Therefore, Western markets could be in trouble. And if Western markets will be in trouble, the knock-on effect, the domino effect will hit everywhere. Already, Indian markets have tumbled since October. So it's not that markets elsewhere are booming. Emerging markets are not necessarily booming right now. So we are headed for a period of, as we said, at the end of the year, increased volatile, uncertain, complex, and ambiguous world. And this sort of climate dampens animal spirits, and ipso facto global markets are now extremely nervous, and therefore we can expect a financial meltdown. We can't predict when, otherwise Glenn and I would be billionaires, which we are not, but troubled times ahead.
Yeah, I think the cause of the shift in the trends of the gold chart and the yield chart and of apprehensions and reactions everywhere is pretty clear and pretty simple, actually. It's the return of Donald Trump to national prominence, and now his election, and now his policies. And the U.S. economy, with the exception of a long-term debt issue, has been more than robust by just about every measure. But that's quickly coming to be no longer the case. And when you increase tariffs, you then are going to depress international trade. You'll increase pressure on employment in the selling markets. In the U.S. is the critical economy for China and for Europe, and less for the rest of the world, but dependent upon the health of the U.S. economy and its dynamism. When you reduce research and development spending, You fire people, which increases the deficit, frankly, by eliminating. This is a Republican bit of lunacy, which is secondary, but the Republicans like to destroy, to the extent they can, the Internal Revenue Service because they don't like taxes, and they view it as totalitarian to have someone taking your money. But as you reduce literally employees by dozens and even possibly in the hundreds of billions of dollars per year in tax revenues, you increase the deficit because you don't have people paying their taxes anymore. Otherwise, a lot of these personnel changes are achieve the objective of making the government smaller in absolute terms, but don't do anything about what is the ostensible reason, which is to cut costs in the budget, since the budgetary items that take most of the U.S. spending are military and social services, not the administrative costs of having a couple 100,000 federal employees. So you have increasing tariffs, likely increasing inflation,
military, social security, Medicare, Medicaid.
All of which will depress demand and increase the likelihood of a recession, if not depression. And of course, that doesn't just spook foreign, as in non-American markets, but it closes them off. And so the effects on China and Europe are going to be dramatic also. So all of this is happening directly because of the increasing changes being applied to the economic policies of the United States by the Trump administration.
I mean, to be fair, Glenn, many economists within the government, and all of them respectable institutions like the Congressional Budget Office, such as even the Treasury's own internal estimates, say that you cannot have an endless growth in defense spending and social security. So they've all argued for reform. They've all argued for
long-term debt problem, yes, but yes, not. I mean, this is an issue for 10, 20 years that it'll happen.
Correct. So exactly. So it is a long-standing problem, but the way to solve it is not to torch everything and not to throw the baby out with the bathwater. The problem isn't just imaginary.
It's the political and paralysis and that makes any meaningful policy step to address this issue impossible. If spending were to increase, if spending were to decrease and revenues to increase by a total, I believe it is 3% of either GDP or federal spending, I forget, which is not beyond, not too onerous, frankly, a change. The federal deficit problem would be resolved, but no one has been able to agree on that. And that gets to a point, and I know we're running out of time, that our colleague Peter Isaacson raised, if I can find it. He said, well, in any event, something to the effect of, okay, you and I have laid out a case for the incompetence or incapacity of the leaders that we've talked about in the countries. So it sounds then implicit that they will be removed. The question is how. My only answer is alarming because I don't know, except that historically, in crises like this, where the political system is more paralyzed than ever and totalitarians rise to power, the only way has been through violence. And I don't want to say that, but I don't. That becomes more likely each day.
That cheery note, thank you very much for listening to another edition of FA Exclusive. We will see you next month. Until then, hope we don't have World War III. Hope there's food on your table. And hope you get up in the morning and life goes on as normal. All the best. Bye.
Auf Wiedersehen.
Join the conversation at Fair Observer and subscribe to our YouTube channel.